Sometimes you're just drowning in information, right? Trying to understand what's really going on with a company, but all you get is noise, headlines. It's tough. Like finding one specific signal in, I don't know, a blizzard of data. Well, that's what we're here for today. Welcome to our deep dive on TOST, incorporated ticker TOST. They're the big all-in-one tech platform for restaurants. We've got a really detailed financial analysis report here, plus market sentiment data, all fresh as of July 16th, 2025. And our goal, simple. Cut through that noise, pull out the key insights, and help you get a clear picture of Toast's investment story right now. And, right off the bat, there's this really interesting conflict that reports says Toast is at this critical and positive inflection point, financials looking strong, but analyst sentiment, market buzz, surprisingly cautious. It sets up what the report calls a classic battleground stock. Really fascinating. Okay, so let's unpack this. The report talks about a transformation happening at Toast. Where do we even start digging into their fundamental story?
Well, maybe the best place to start is with the core rating itself. The report gives Toast an excellent fundamental score. That's a 4.66 out of 5. And importantly, this is based purely on the business's health. It deliberately strips out market sentiment to focus just on performance.
Okay, excellent. 5 stars. That's a strong signal. The report also seems to put a lot of weight on future growth over just past performance. Where does that story begin?
Right. So historically, say fiscal 2020 to 2024, their strategy was what the report calls an aggressive land grab. Like massive investment, trying to sign up as many restaurants as possible. It worked for growth, triple-digit revenue increases. But the flip side was significant operating losses, negative free cash flow. They were burning cash to build that footprint.
Standard Silicon Valley playbook for a while, right? Grow fast, worry about profit later.
Exactly. But the big turning point was fiscal year 2024. That was the first time Toast actually reported positive GAAP net income. And importantly, substantial positive free cash flow, too. That really marked, a new chapter, financial maturity arriving. Okay, so they flipped the switch. No longer just growth at all costs. They're proving the model works, generates actual profit, but growth is slowing down from those crazy triple digits. The report mentions 18-24% forecast. Is that still considered strong? What's the quality of this growth now?
That's a great point. And it gets to this idea of evolving growth quality. Yes, the top-line revenue growth is moderating, but it's still very strong. 18-24% is nothing to sneeze at. But the real standout feature, looking at forecasts for 25 through 27, is the explosive growth expected in profitability. We're talking net income growth projected over 100%, EBIT growth around almost 80%.
Wow, okay. So revenue growth slowing a bit, but profits are set to skyrocket. How does that work?
It's all about operating leverage. As a platform business saws, fintech, the cost of adding another customer or processing another transaction is relatively low once the platform is built. Those heavy investments from the land grab phase, they're now bearing fruit. Each new dollar of revenue is just much more profitable.
Yeah.
Got it. So less cost attached to new revenue coming in. That's the shift from just growing to growing profitably.
Precisely. It's a fundamental shift. And what's fascinating is how quickly they managed this turnaround on the profit side.
Right. You mentioned that turning point in FY24. How dramatic were those improvements in margins?
Really dramatic. Take gross profit margin. It went from under 19% in FY21 up to nearly 25% in FY24. That shows they're managing costs better, maybe getting better pricing power too.
Okay, that's significant. What about operating margin? That must have been deep in the red before.
Oh yeah. Operating profit margin was negative 14% back in FY22. Just 2 years later, FY24, it's positive 2.5%. A huge swing, showing real leverage over operating costs like sales and R&D. And net profit margin followed suit, turning positive. Plus, things like ROE return on equity and ROIC return on invested capital also flipped positive in FY24.
So the business isn't just making profit on paper, it's actually generating value from the money invested in it.
Exactly. It's creating value now, not just consuming capital.
And what about that SaaS metric, the rule of 40? How's Toast stacking up there? It's a key benchmark, right?
It is, yeah. It's a good heuristic for SaaS health.
Yeah.
You add the revenue growth rate and the free cash flow margin. Ideally, you want it over 40%. For FY24, Toast was around 36.5%. That's about 28.3% revenue growth plus an 8.2% free cash flow margin.
So not quite elite territory yet, but getting close.
Getting very close. The report says they're nearing the target and definitely on the path. It shows the efficiency is really kicking in alongside the growth.
Okay, profitable growth, improving efficiency. What does this mean for their overall financial stability? The report uses this term, fortress-like balance sheet. Sounds impressive.
It really is. It means they have a super strong financial foundation. First, liquidity is robust. Their current ratio and quick ratio for FY24 were both well above 2. That means plenty of liquid assets to cover immediate obligations. And they finished FY24 with almost $900 million in cash and equivalents, a very healthy cushion.
Wow, nearly $1 billion in cash. And are they loaded up with debt from that growth phase?
Actually, no. Quite the opposite. They've aggressively paid down debt. It fell from over $170 million in FY20 to just about $34 million by the end of FY24.
So hardly any debt. They're financing themselves mostly through equity and their own operations now?
Exactly. It's almost entirely financed by equity and cash flow. And that strong, low-debt, cash-rich balance sheet gives them huge strategic flexibility.
Flexibility how? Like for acquisitions or weathering storms?
Both. They can easily handle economic downturns. They can invest heavily in R&D to stay ahead, pursue M&A if the right opportunity comes along, and they can even offer financial products or better terms to their restaurant clients, which kind of reinforces their whole ecosystem. It's a powerful position.
Okay, so let's recap the fundamentals. Excellent ratings, strong growth, shifting to profitable growth, margins expanding rapidly, nearing rule of 40, fortress balance sheet. It sounds fantastic. But, and this is the big but, right? The market isn't throwing a parade. Analysts are cautious. Why? What's going on with the sentiment side?
Yeah, this is where that battleground idea really comes into play. Looking at the analyst section 4 of the report, you see this clear split. The official consensus rating is a buy, but digging deeper, a full 50% half of the analysts covering TOST rate it a hold.
Half are on the fence. With fundamentals like that seems odd.
It is unusual, and it strongly suggests the debate isn't about whether TOST is a good company. Most seem to agree it is. The debate is about the price. Is the stock too expensive right now?
Ah, the valuation question. Does the price target reflect that caution?
It does. The consensus price target is around $44. The stock, as of the report date, was trading slightly above that, around $44.34. So analysts collectively see very little near-term upside from the current price.
Okay, price targets are flat. But you mentioned TOST keeps beating earnings estimates, right? Sometimes by huge margins.
Massively. Yeah, they have a strong track record of beating EPS estimates like 200%, even 600% beats in the past year.
Yeah.
But, and this is key, the future earnings estimates haven't really been revised upwards much. They're staying flat.
Yeah. So they beat expectations, but analysts don't raise future expectations. Why not?
The interpretation is that analysts are basically baking in TOST's own guidance. TOST keeps saying they'll continue to invest heavily in growth initiatives, R&D, platform expansion. Analysts seem to believe these investments will temper the pace of margin expansion in the very near term, even if the long-term trajectory is good. So they beat, but the outlook stays cautious due to planned spending.
It's like, great job, but we know you're going to spend that extra profit.
Kinda, yeah. And this leads to a really wide range in individual analyst price targets from $28 all the way up to $50.
Huge range.
Classic sign of a story stock at an inflection point. You've got the bulls looking long-term at the huge market and potential, and the bears looking at current valuation multiples and near-term spending plans.
Definitely a battleground among the pros. What about outside the analyst community? Broader market, news sentiment, retail investors?
It's also pretty polarized out there. News sentiment is generally balanced, reporting the good stuff like big client wins with Topgolf and Applebee's, but also covering the cautious analyst notes. Pretty factual.
Okay, balanced news. What about individual investors?
General investor sentiment, especially what you might call retail sentiment, seems highly positive. The report cites sources indicating maybe 95% bullishness there. These investors tend to focus on the big picture, the disruptive tech, the massive total addressable market for restaurant tech, the long-term growth story.
95% bullish. That's really high. So who's on the other side of that trade? If retail is buying, who's selling or betting against it?
Well, in stark contrast, as the report puts it, you see significant bearishness among professional traders. This shows up in the short interest figures. Short interest is elevated at around 7.2% of the float. That means a non-trivial amount of money is betting the stock price will fall.
Right, 7.2% short interest isn't insignificant. So you have very bullish retail clashing with fairly bearish short sellers.
Exactly. And that combination, high short interest plus very high retail bullishness, creates this potential for significant volatility. It's the perfect setup for a potential short squeeze.
Explain that quickly, a short squeeze.
Sure. If some positive news hits or just strong buying pressure comes in, the stock price starts rising. The short sellers, who borrowed shares to sell hoping the price would drop, start losing money. To cut their losses, they're forced to buy back the shares they borrowed. This buying demand adds fuel to the fire, pushing the price up even faster, forcing more shorts to cover. It can lead to rapid, sharp price increases.
Got it. So a volatile mix. This tension is really the core of it, isn't it? What's the big takeaway then?
I think the big takeaway is this clear split. On one hand, you have the fundamentals. TOST gets that excellent overall fundamental rating from the report.
Mm,
It's highlighting a genuinely high-quality company that's made this tough but successful pivot from burning cash for growth to being self-sustaining and profitable.
right. Strong financials, excellent balance sheet, very strong growth outlook focused on profitability now, good trajectory on efficiency.
All boxes checked on the fundamental side. It's a solid operation, validating its business model.
So fundamentally, the report paints a picture of a high-quality, high-growth business doing the right things.
Yes. Which brings us back to the core investment question identified in the report. It's not really about if TOST is a good company. The question is, what price should you, the investor, be willing to pay for that quality and for its future growth, given where the stock is trading today and the caution expressed by many analysts?
It really boils down to price versus quality and future potential. So maybe the final thought for you listening is this. When you're looking at a company like Toast, how do you weigh that? How much importance do you give to current market sentiment, the analyst debates, the short interest, versus the underlying fundamental strength and the transformation story we've just discussed? How do you decide when that impressive turnaround truly justifies looking past the market's current show-me attitude? Something to think about.